Alright guys, so global markets today they're selling off and we must understand why. A week ago we talked about how the new US economy is setting the world into a tailspin. How in 2025 we could see not just a currency crisis but an asset crash across the globe. And it's really important we understand the storm clouds forming. Trump's trade war is wreaking panic and it's not just restricted to China. G7 allies and their economies are the most exposed to US policy in 2025. Now, the Federal Reserve has signaled that rate cuts could virtually stop this year. In a world that needs US interest rates to go down, this spells disaster. And it's especially so for economies that are over leveraged, spending too much, and those whose growth is stagnating. And now the UK is the latest casualty. We are having another Liz Truss moment where the real driver of today's economy is falling apart. And it's serious because other G7 members and emerging countries they are next. Britain's bond market is literally collapsing. The UK's long-term borrowing costs hit the highest level since the 1990s. In other words, UK bond prices have plunged to a 25-year historic low. So investors are burned. And on the consumer level, yields have flown up. If you need to borrow money to finance anything, well, you're effectively screwed. The key issue Britain faces is a collapse in trust. When investors buy bonds, they are looking for the country's economy to grow so that they won't default. But they also demand that government spending is controlled so that the currency won't collapse. Well, the UK has none of that and money is leaving British assets. Government debt has risen to the highest level since the early 60s. In fact, we are fast approaching World War II levels. Debt to GDP is about to hit 100%. And unlike the US, the amount of debt in the UK matters much more. Without the backing of the US dollar, demand for British bonds is not guaranteed. The UK economy has effectively stalled. Productivity is down, government investment is also down. And let's not forget the exit of cheap Russian energy. And all those plays a part in decimating British industry. Now, sounds like a familiar theme, doesn't it? Is the EU story repacked for the UK? And investors, they hate the outlook ahead. British growth is going to lag the G7 average through 2029. As a whole, the Western Bloc will grow at around 1.8%, but the UK in black will be much closer to just 1%. In fact, all these projections are very optimistic. The US, on the other hand, will grow at over 2% of GDP. Now, sure, it's growth powered by deficit spending, but investors know that even that is more sustainable than the UK thanks to the dollar and the US consumer market. So, financial power, money, is jumping ship now. So, if higher interest rates continue, it will hammer economic growth for the UK. And according to projections, it will reduce GDP growth this year by 0.3%. And to the markets, this is horrible news. It means the government will have to borrow and spend more, and that in itself could debase the currency. Now, if British bonds yield 4%, but the pound collapses by 4% or more, you have made nothing. You could even lose money from the currency risk. There's another issue to consider. The share of UK foreign bond investors have grown to an incredible amount. In 2004, it was just 15% of total debt, and 20 years later, it is around 29%. These isn't local investors or British banks buying the bonds. These are foreign holders who want a real return. And the lower the currency plunges, the bigger the urge to sell off their bond holdings. They are not loyal here. And what we are seeing is a byproduct of US economic policy. As US rates stay elevated as the dollar rises higher, it is a wrecking ball that destroys global debt markets. It doesn't discriminate. Money would flow away from UK assets into US bonds. It's the classic safe haven trade because, as ridiculous as things are, the US dollar is still the reserve currency of the world. It is the benchmark. However, this has big consequences for the UK and the British people. And this is where the story gets tragic for the man on the street. Now, thanks to British bonds collapsing, mortgage rates in the UK could fly up to the moon in 2025. 700,000 borrowers will be paying higher monthly payments in the very near future. This year alone, UK households face a £1.2 billion bill when they refinance their mortgage. The amount of bigger housing payments is starting to trend up once again. But what if rates continue to stay high? What if UK rates go even higher? That's going to destroy the middle class. If all your money is spent on mortgage payments, what else do you have left at the end of the month? What Britain is facing is the stronger dollar taking away liquidity. The combination of rising bond yields in the US is causing money to flow from world economies into the US. And this is basically the system we are in. The domino effect goes beyond UK bonds. It also affects the currency, the pound sterling. If demand for British debt collapses, so does the need for the local currency as well. And that's why the pound has dropped back down to the lows in 2023. In just 1 month, it has dropped 4% against the dollar. Now the damage has spread to people on Main Street. Imports are going to cost more. Shopping at Harrods is more expensive. Buying groceries is going to cost a bomb. And that's the problem with the US dollar system. When things go haywire, it affects everyone. And this will be a synchronized collapse, and the weakest economies are the first to get exposed. Now, as we speak, it's Friday and the markets are collapsing hard. Now, yesterday we said how higher rates pose an enormous collapse risk, a threat for assets. 2024 was an invincible year for stocks. We all saw huge gains. The S&P returned well over 20% easily. But the narrative is about to change in 2025. And we have to discuss how high US bond yields can go. The 30-year has gone past 5%, and the 10-year yield has officially gone past 4.7%, heading towards 5 as well. All the gains this year have been wiped out. The jobs report still shows a very robust outlook. Over a quarter million jobs were added in December, and that is giving the Federal Reserve more cover. The excuse to keep rates high is still there. So the big question is, how high can bond yields go and how long can they stay up there? Because if it goes on for too long, it could tip the world into recession, and yes, as a consequence, the markets would most definitely collapse further, especially when valuations are just so high today. Now we just need to look at how much money the Treasury is going to borrow. This quarter alone, from January to March, Yellen and her replacement will be borrowing $823 billion. That's a tsunami of bonds hitting the market. So the supply of treasuries is going up during a period where the Federal Reserve refuses to cut rates. And that's why bond yields are heading to outer space. When we mix in the threat of global tariffs, it adds even more fuel to the inflation fire. A few things are guaranteed, they're baked into the cake when Trump decides to clobber the world. The US will suffer from a higher CPI, prices on the shelf, they're going to go up, so domestic inflation in America could get very much worse. Secondly, the flow of dollars to the world will slow down. Now there's a scarcity of the greenback, and what does that do? It pushes the dollar higher and crashes global currencies around the world. Now we have the world from Asia all the way to Europe suffering from higher import costs. Inflation globally starts to pick up as well, the stock market collapse we are seeing today could get exponentially worse. Diving deeper into consumer expectations, we can see a problem. Americans expect prices to climb higher than before. CPI for the next 10 years will stay at 3.3%, 30 basis points higher, and this poses a big problem. The Federal Reserve's job is to convince people like you and me that inflation isn't a problem. In other words, they want people's expectation of inflation to trend down. And in Powell's world, everything looks like a nail. The only tool he has left is high interest rates, which is the hammer. Now, the odds of a big rate cut in 2025 are slim to nothing, and Slim just left the building. There's another big factor why markets are selling off hard. The US economy is built on credit card spending. People swipe their plastic like there's no tomorrow. But if annual rates continue to stay high, defaults will rise and banks will start to lend less, and it's already happening. Outstanding credit card debt has dropped by nearly $14 billion, the most since the pandemic. People aren't spending anymore, and banks, they are afraid to lend. Why? Because APRs on credit cards are at least 22%. And with bond yields going higher, it'll continue to stay at that level or maybe even go higher as well. So we have this deadly cocktail of events coming for the world and the US economy as well. No one is immune to the coming train wreck. This playbook has been repeated time and time again for the last few decades. Every time the dollar flies up, it causes a global currency and bond crisis. But this isn't good for the US and their hegemony as well. It reminds nations to break away from the system, and it's why countries like Indonesia, they are joining BRICS. They want to rely less and less on the dollar system, to trade more in local currencies and borrow more money outside the USD. And it's not a coincidence that BRICS is expanding. Now, what's alarming is how even the UK is running to the Chinese for rescue. And as we mentioned many times before, the only way to reduce dependence on the US is to trade more with China. Rachel Reeves will meet the vice premier in Beijing to push her agenda. Now, Russia, Taiwan, and Hong Kong, they're on the list, but those are just the side shows, the appetizer before the main course. What the UK really wants is increased trade with China, especially when the US is starting to turn inwards. And very soon, we could see the US importing fewer British goods. In addition, industries could leave British soil for the US as well. Trump's tariffs could trigger a wave of deindustrialization in the UK, the same thing that's happening in Europe today. And if Reeves doesn't solve this, trust in the British bond market and the pound sterling could erode even further. China's trade with Britain has fallen off since 2021. Both imports and exports they are down. The Chinese have other outlets, especially countries and allies in the BRICS. So the UK will have a titanic struggle to reverse this because the Chinese economy, at least in manufactured goods, is self-sufficient. So it's going to be very interesting to see what Starmer's government has to offer. But if they don't, then the situation in Britain could get from bad to worse in 2025. Investments from Beijing needs to come in, exports to China also needs to increase. And let's take a step back here and take a holistic view. The short-term effects of this crisis is clear for everyone to see. Global currencies, they are collapsing. Bond markets all over the world, they are under pressure. And as US yields continue to rise, the stock market is also crashing hard. Even Bank of America changed their forecast. There will be no interest rate cuts in 2025. The labor market is proving too resilient, and the Fed cutting cycle is over. So we must prepare for nasty things ahead in the months to come. But the longer term effects are also quite clear. More countries will be forced to diversify the trade and economic ties. As the US decouples from the world, even the G7 will have to look elsewhere, and the only alternative left is BRICS, and more specifically, China. So hang on tight, guys, there's probably more downside to go. However, remember that the end game is still inflationary, so don't over leverage yourselves and don't panic sell. But let me know what you think. Will higher rates take down the global markets? And which Western country will run to China next? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.